Welcome to Yellowtown and Tradier Hub. And today we're going to have a live broadcast of our live trading session where we talk about current market condition. We are just done with the FOMC meeting. What to expect going into the end of March, going into the next earnings season that starts in the middle of April. And we're also going to talk about earnings. We had Micron earnings today, and then actually yesterday. And then we have Nike earnings after market close. So earnings volatility has been significant, right? You can see that the two standard deviation moves on earnings have occurred a lot more often than in the past. I would say probably 4 or 5 years. Again, stocks that do well and mention AI and deliver on bottom and top line, they move two standard deviation to the right, higher in case of Micron today. And stocks that did not do as well, they move two standard deviation to the left, like in case of Accenture today, right? Moved 10% lower. So that trend continues, and I think it's going to stay like that. So how do you take advantage of that trading setup? All right, am I sharing my screen? Yes, perfect. Okay, perfect. So that's my brief bio. For those of you who are new, welcome. If you're part of Tradier Hub, welcome. My background, the difference is that I have experience in technology. So my background is technology. I was a CTO of several publicly traded companies. Options Express is one of them. And I started Yellow Tunnel about 5 years ago, and always been in technology, right? So we have a team of financial engineers that are constantly building new models and enhancing our existing models using latest advances in artificial intelligence, neural networks. We cluster stocks into different categories, and then we find the best models that can predict the stocks, right? And then all the stocks get ranked, and then you get the signal that basically says, based on our inference engine, once the training is done, the model basically says which stocks can outperform their respective peers and the sector and the indexes. So that's our background, my background. And then I actually trade these signals in the live trading room, and we'll see that today. Disclosures are important, so please read them. Obviously, trading stock and options involve risk, not suitable for everyone. So it's important if you're new to trading stock or options to visit optionsclearing.com so you can understand the risk associated with trading stock or options. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education and information purposes only. Please consult your financial advisor prior to making any trading decisions. Bob, Brad, Cecile, Patrick, Thomas, welcome. Fred, Steve. Do me a favor, type in yes, just to make sure you guys can hear me and see. I want to make sure that we are not missing anything. Bob, thank you. Perfect. All right. So first, let's just go over what happened yesterday, right? We had FOMC meeting, very important. And if you look at the interest rates, right? Initially, they dropped. Right after the FOMC meeting, they recovered some of the ground, but nonetheless, you can see that interest rates looks like they're overbought and started to pull back, challenging retesting 200-day moving average. So overall, I think the Jerome Powell was dovish, right? He basically reiterated 3 interest rate cuts. That was the risk. He would say that inflation, we're concerned about the 2 months in a row higher than anticipated inflation, then I think market would have a different reaction. But because he said that he's not concerned, at least with the current situation, with the current 2 months, that gave a green light, and still wants to do 3 rate cuts, because he's also concerned that if he doesn't cut the rates, that there could be a detrimental effect to the economy, potential recession, people losing jobs, and since there's a dual mandate, right, price stability, and looks like prices are stable, at least trends in over a long period of time lower, and second mandate to keep low employment healthy, and he doesn't want to jeopardize it by keeping rates too high. So, and market obviously took it very positive, very bullish. You can see QQQ today made all-time highs, giving up some of its gains, but made new all-time highs marginal. And spiders are decisively trading, broke through the recent past record. We consolidated here in a few weeks, 517, and now we're trading at 523. And also small caps, interest sensitive sectors, small caps retesting multi-year highs, right? The breakout above 205, very bullish. Regional banks are leading the market. Silver, gold pulling back slightly. Again, they rallied yesterday significantly because the dollar pulled back. And now dollar actually recovered most of the losses from yesterday. So that we need to reconcile that, right? I think if dollar continues to rally and goes to 105, maybe even 106 level, that would be bearish for the market. So there's still some currency market, treasury market, and equity market where some people think they're more concentrating on higher inflation, and there's some pockets of market that concentrating on equity bull market, and that the growth, the GDP was revised up, right, by FOMC committee, right? So higher growth projected. And you can see gold also continued to break out and made new all-time highs, pulling back today, but nonetheless continues to rally. So that's in summary where I see the market is. And if we want to look at the key support and resistance levels for spiders, basically 520, 512, if you zoom out 6 months, the overhead resistance is at 520, the support is at 512, right? And then if you zoom out, 6 months prediction, you can see 520 is the overhead resistance. 480, we broke through the overhead resistance. We still have 10 more days. So you can look at positioning, right? I'm using Tradier Hub, Tradier tools to find dealer positioning on spiders. Basically, into April, the biggest positioning, if you look at the strike price, is 525, right? 525. There are a lot of positioning going into May. Not yet. So I think 540. This is 540. I didn't press the right button. 540. So we're at 522. There is overhead resistance initially into next March 22nd. That's this 520. Oh, this is exactly 522. So here, 530. So the first, we have some 20,000 VANA, positive VANA. That's high open interest rate, just open interest, not open interest rate. Open interest, a lot of demand for buying and selling 530 calls, and much bigger positioning is at 540. So somewhere between 530 and 540 is where you can potentially see the market moving to the upside as we approach in the earnings season. On the downside, you have some positioning at 505, right? We've retested this level many times, and much bigger positioning 500. So I think at this point, market is trading between 500 and 530, 535 on spiders. Right, so 500, it's 50-day moving average, pretty well positioned, pretty well defended. 505 is as well, so that would be this week low. And to the upside, I think market could get 530, 535 going into the next earnings season. All eyes are on small caps. A lot of people are bullish on small caps. It's trying to break out from this overhead resistance. And if you zoom out and look at the weekly chart, you can see this is a multi-year overhead resistance, right? So I'm looking at these peaks. So a lot of people anticipate a significant that small caps are going to start doing the catch up, especially with interest rates going lower, right? So we're still kind of need to figure out whether inflation is transitory or not. I think that's the risk to this rally. But if you just look at the price action and ignore, inflationary data, we do want to see kind of this above average move to the upside. And I think it's just a matter of time. It's just a question, is it going to be this? Well, probably maybe not this quarter. This quarter is coming to an end, but probably Q2, Q3, I think there will be a move to the upside in small caps. So a lot of people are waiting for that. We've seen this in biotech, right? We had a strong upward breakout. It consolidated back to the support line. Support line held. I think we need to get clear 105 level on biotech. Banks, right? These are the main beneficiary of the current environment. JP Morgan, kind of a vertical move to the upside. Citigroup, Wells Fargo, vertical move to the upside. Industrials are one of the main beneficiary. Continue to move vertically. Stocks like General Electric, right? Kind of continues to make new highs. So cyclical names, right? You have late cyclical names like energy, right? If you look at MPC, or if you look at the ExxonMobil, you see that commodities. Make sure I didn't miss any messages. Okay, how are we doing on Tradier? Tradier is good. Last time I forgot to share. Okay, so we're good on Tradier. So ExxonMobil, so energy, financial, industrials, materials. That's where we lead in the market. QQQ is mega cap technology struggling, right? Well, if you look at Apple today, right? So struggling, was year-to-date low, continue to post in new lows. Apple, Tesla, right? These are the underperformers. And Google's of the world, the outperformers, they're still kind of trading sideways. They're not making new highs, including actually NVIDIA, right? The leader, not participating in the current rally. I mean, off the lows, but not making new highs. So it's definitely, you have to be selective in which asset classes you're going after, right? And not all stocks moving in equal. So having models, right? You can see it. We publish every day, let's say aggressive power trader, right? Every day we publish which stocks can outperform the market. So you have Morgan Stanley, right? Predicted today. Morgan Stanley is up significantly today. Citigroup was the signal, significantly up. Credit cards like Capital One Financial, right? Significant move to the upside, trying to break out. So model is doing a good job, basically ranking all the stocks, assigning them probability of moving higher, and based on inference says, well, these stocks for today, I think are going to go higher, right? And if you want, instead of short term, if you want weekly trader, then you could go to weekly power trader and kind of review signals, American Express, General Electric, LA Lilly. So these are the signals for a little bit longer term, and then I trade them, right? You can look at the orders and positions, and you can see, I actually traded JP Morgan today. I don't trade all signals, but you can see the performance and you can see the actual individual trades. All right, so any questions on sectors and what to expect? Sorry, my wife just relentlessly. Okay, so that's the signals, the models, and then earnings, right? So we're going to talk about earnings. So again, Micron hit a home run today. You can see I actually traded Micron. I traded PDD. Sometimes I do butterflies. Sometimes I do iron condors, right? But I look at those different strategies. So basically, Going into the event, you want to decide, am I going to be long the volatility or I'm going to be short the volatility? Right? Looking at the historical volatility, look at the implied volatility, looking at the open interest, where can, how are people positioning, and are the options overpriced or they're underpriced? So in case of PDD, I did the butterfly. In case of Micron, I just did a single call, which was a good trade. But you can see that Micron, if you look at the strike, right? If you look at the strike for Micron, basically staying at 110 level. And if you were looking at this chart yesterday, right, this is where the highest open interest was. The highest open interest yesterday was at 110, right? Exactly at 110. And I can maybe actually show. Let's see if I can find the screenshot. Actually save them all so I can reference. Right, saving these screenshots I think are important. Also important to keep a journal, right? You want to keep a journal so you always document all your trades. Right, so you can see Micron in terms of this screenshot of dealer positioning yesterday before the earnings announcement, and where was the open interest the highest, right? Where the bulls and bears met. So you have, if you can see it here, the March 22nd, the highest interest was at 110. And then pretty large negative VANA in the April. So we have weekly and monthly, the highest was concentration at the strike 110, right? The highest concentration. And that was actually 2 standard deviation. Micron hasn't moved more than 10%. I think ever, actually. I mean, you have to go, at least past 5-10 years to see Micron moving 15%, right? Because why? Why is today 15%? Well, because of AI, right? You get rewarded if you mention AI, and especially if you actually able to monetize it, right? And sell more chips, and the demand for chips is growing, right? So then you move to standard, right? I think I'm reading a book by Black Swan Event, right, by Talib, and he actually talks about he's a famous hedge fund quant. He writes different books, Anti-Fragile. So I'm reading Anti-Fragile by Nassim Taleb, and he talks about probabilities, right, and that were conditions to say that, well, if the stock never moved 2 standard deviation, it's not going to move today, right? And that's not the right assumption, right? It might not move in the past 10 years 2 standard deviation, but this year or in the past few quarters, it moves beyond the 2 standard deviation, right? So you have these tail risks, right? And the tail risk events, the probability of them rise in this current market environment. And that's why Micron has actually moved up 15% and kind of frozen at the 110 strike price level. Any questions on Micron, on current conditions? Bob, Brad, Silma, Foos, Patrick, Todd, Thomas. Okay, so that's Micron. We have 223. Let's talk about, I did my homework. So I did Nike, FedEx, and Lululemon. Lululemon is not liquid, $470 stock. One contract, you're trading $40,000, right? So average account in Yellow Tunnel is $10,000. And I think even in the United States, it's a little bit, maybe $7,000 average account. So trading one contract of Lululemon, $47,000, doesn't matter what your view is, right? Just like Nassim Taleb said in Anti-Fragile, that doesn't mean that it's not going to move beyond your anticipated level. So if you're off by 1 or 2%, which happens, right? Well, or sometimes more, right? In case of Beyond Meat, I was off, by 50%. So so if you're off by 1 or 2% on the $475 stock, well, it's $1,000, right? So if you're down $1,000 in $10,000 account, well, that's not good, right? That's not a good educational example that I can provide. And same thing happens with FedEx, right? One contract, if I'm off by 1 or 2%, well, that's $500. My goal not to risk more than 2.5% on the $10,000 account. So $10,000 account, 2.5%, $250. So with the FedEx, if I'm off by 2%, I'll be down close to $500, which I also don't want to do. So I'm going to go with Nike. Plus, it's the most liquid name. It is volatile. It has been moving significantly above about 10%, 11% in the past few quarters, right? They're dealing with inventory, with China issues. So I think it's going to be the same reaction, right? Like PDD, in example, right? Well, this is Chinese retail name, right? It's not US-based retail, but nonetheless, they derive a lot of revenue from China, right? Initial reaction up 10-15% or more, I think, which was again 2 standard deviation move, right to the upside, and then in first 15 minutes completely rolled over. So Nike could be the same thing, right? I expect volatility in market to pick up. If you look at Nike, sorry. So an example of Nike, I did my homework, right? And I looked at the implied volatility move. Let me just double check. So looking at Nike, so the put, 90 put, right? Big demand, relatively big, right? April 19. No, actually, large demand, right? So minus 2,000 VANA, right? This is sensitivity of change in price of stock and options to the volatility, right? So, but that's maybe not as important. What's important is that it's negative, right? That means people are selling puts. They're very bullish on Nike. They think it will not break below 90 level, right? Similar to Micron setup. And that it in very large position at 110, the front week, right? March 22nd, the biggest position is 110, implying 10% move in Nike, right? So the implied move is 10%, which is how much it moved. Beyond, this Friday, if you go into April, some people actually think it can get to 120, but that's by April. If you take April away, biggest position is at 110. And it's pretty well hedged with next week at 114. So I think it will gravitate toward 90 if, they have China problem and inventory is building and nobody wants to buy Nike shoes because they buy on air and dozen other brands. Or it's still a very popular brand. They resolve their inventory issues. Excuse me. And just like PDD, initially it can gravitate toward 110 strike. Sorry, I'm getting a little bit sick again. So how can you set up this trade where you don't risk a lot, right? Because just because it's at 110 doesn't mean it can go to 120. Right, it could move 20% up. Right now it's trading at 100. Excuse me. And just because it is at 90, that doesn't mean it cannot move to 85, right? But that's where the supply and demand meets. So I propose to do butterfly. Propose to do butterfly with the assumption that it's probably not going to sit idle. I mean, butterflies are great. Directional butterflies are great if you have move to the left or to the right. But if it just stays in the middle, right, and moves 1 standard deviation, well then, this is going to be a losing trade, but you are risking small amount to potentially, just like in Micron, you can make 2 times your investment, 3 times, and so on and so forth. Depends how much risk you want to take and how much you want to structure it. So let's set this up. First let's visit our friends at Tradier Hub and just verify based on implied volatility that's what that's not just high open interest. What is implied volatility actually says. And usually the calculation that I make looks like Olive Garden. Dropping on earnings. Having troubles to DRI dropping on earnings. Thank you, Bob. All right, so let's look at Nike. So if you want to know what the implied volatility is, right? If you want to know historical volatility, you can go and look at the stats, right? Volatility, actual volatility, implied volatility rank, right? So you have a lot of great tools, right? But implied volatility is very high, right? IV rank is very high, meaning that going into the earnings, you have a lot of demand for these options. So the implied volatility for Nike, trading at 101, quick calculation. Usually I do straddle and strangle. Like if I want to know 2 standard deviation, I just add 4. Plus 4 is 8, and 8 plus 4, say 4 and 4, so 16, right? So one standard deviation is $10 move. That would be the 110. And 2 standard deviation move would be 16, which would be close to 116 level, right? So 110, 116 level. Let me see what I put there. All right, so let me look at what I did. Okay, so I sold 115 call. Okay, so I sold 115 call because implied, even though the highest position is at 110, and it will probably gravitate toward 110, implied volatility, 2 standard deviation is 115. So I want my short strike to be at 115, and I want my long strike to be at 110. Right? It was the idea that it will get to 110, but it's not going to break 115. And if it stays at, this is what, 112. So if it stays at 112, or 113, then that would be the biggest profit on the call butterfly. All right, so 115. So let's set that trade up. Let me know if you have any questions why you decided to select this strike. But I'm going to set it up and show to you shortly. How are we doing now? 2:34. We have time. So basically what I'm doing here is I'm selecting 215 to be my middle strike, 115 to be my middle strike. That's the sell. And then I'm buying 110 and buying 120. Sell 2, buy 1, buy 1 for 43 cents, right? So 43 cents. You can have a broker if you don't think it's going to get to 120, right? If you don't think it's going to get to 120, right, because there's not a lot of demand and supply, then you can get cute and maybe instead of 120 have like broken wing butterfly buy 122, and then instead of 42 cents you're going to spend 38 cents. I'm not sure if it makes sense for 4 cents. I mean, even 125, you're saving 8 cents. I mean, especially if you're not used to butterflies, that would be the trade. So 42 cents. So let's see, Nike, butterfly, strike interval 5. So I want my middle strike to be at 115. My middle strike to be at 115. It's 42 cents. Let's see, is Nike part of the portfolio? Yes, it is. Okay. $0.43. Okay, 44 cents. Okay. So if you're part of the earnings power trader service, then you can see Nike, right? I bought 110 call, I sold 2 times 115 call, and bought 120 call for 45 cents. So that's the bullish call spread, right? If you think Nike is gonna go higher, right? Because it's oversold, right? And keeps the support pretty significant support. Or if you think it's going to roll over and reach 90, right? And that's actually the lows, then you would do a put butterfly. I don't have a strong opinion. I have no idea, right? Usually it's a flip of a coin. But I do have a strong opinion that, not strong, I have an opinion that it's probably going to move beyond 1 standard deviation. So then I don't want to take the side. I want to be kind of neutral. So the middle strike, I think, is 90. The one I selected, Nike. Yeah, I selected 90 put. Basically saying that it's probably not going to break 90, even if it misses the new, plus it's well hedged. Right, huge position at, well, it's negative. It's negative. But I think it will gravitate toward 90 and not break too far beyond that level. So let's see how much is the put butterfly. Maybe move out a little bit. Let's see. So middle strike 90. It's a little bit expensive, 74 cents. So again, and the reason it's more expensive, right, 90 versus 115 is because there's more demands for calls, right? And this is only $10 out, where the short strike was 15. So you can do 15 and spend less if you think this level will be broken. If you don't think that this level will be broken, I think 90 is fine. So let me just do 90, 85, 90, 95. Okay. So paying a little bit more because the strike, instead of selling 115 on a $100 stock, that's 15 points to the down, 15 points away from where the stock is trading. Here it's only $10 because I do see one of the reasons is large positioning at 90, right, in April and also in weeklies. So I think it will gravitate toward 90, right? So in the ideal world, if it drops to 90 and stays at 90, that would be maximum gain. Or if it gravitates toward 112, right, or 115 and stays at that level, that would be maximum profit for the calls, right? So the good news is that I'm risking basically 1% of stock price, and the most I can lose, let's say it doesn't move, it doesn't go anywhere, which is also possible. All right, or it moves, even if it moves like 3% or 5%, nothing's going to happen, right? Then most likely I'm going to lose most of this, if not all this premium. So I'm going to be down $1.20, right? $1.20, $120 on one contract, right? So I'm down $120. That's, less than 2.5% of my portfolio. So that I'm comfortable with that risk, right? If I do the same trade on FedEx or on Lululemon, then the risk is much higher. Plus, it's not as liquid. So I think Nike is probably the best candidate for this type of setup. Any questions? Sorry, my wife is giving me a to-do list, and she cannot wait till this is over. Apologize. Okay. Questions? Bob, FedEx. So I can tell you what I'm trading on FedEx. Yes. So I did FedEx. Again, you need to have higher capital. But FedEx, I did the same thing. I did the put spread and the call spread, right? Because FedEx is also, I think, is going to be volatile. So the middle strike that I chose for FedEx is 295, right? 295. The open interest kind of widely distributed, right? You don't have like a strong opinion like we had in Nike, right? You have some positioning at 280, probably not, but you do have a lot of positioning here. 300, right? So 300, I did. Yeah, so I think if FedEx hits a home run, it will move at least 10%, right? And implied volatility actually on FedEx, it could be, 295, right? So based on implied volatility and historical volatility, it's 295. So I propose 295, 300, right? I did 295 because, well, this is 300. I came a little closer. But I would select 300 as your strike, right? And 295 call is trading at 75 cents. 75 cents. So I think if there is a positive surprise, it could get to 295, 300 on FedEx. Right, it had bad earnings last time. It kind of recovering the losses. 300 would be all-time high, right? And especially in this environment, I wouldn't be surprised if FedEx is at all-time high. If they basically say that consumer is strong, inflation is not reducing, kind of say the opposite of what they said last time, right? Last time there was nothing positive in their earnings, so you have a move to the downside. And you see transportation sector is basically at all-time high, right? So transportation sector is at all-time high. FedEx could do a catch-up, but it has to deliver on bottom line and top line. If it does not deliver on top and bottom line, then $215, $235. So you do have a lot of put buying at 230. You do have a lot of put buying at 230, and then let me see what put did I buy. So I sold 230. Yeah. So you have a very positive Venom. So a completely different picture from Micron, right? From Micron or even Nike, right? If you look at Nike, based on the current volatility, right, weighted volatility skew, you have negative Venom, right? You have negative Venom. What does that mean? It's a risk reversal. People are selling 90 put that expires in April, and they're buying 120 call because they think Nike is going to hit a home run, right? Just like Micron. So that's positioning Nike. FedEx is completely different position. It's old, a little boring. Transportation sector. Nobody cares about transportation sector. It's well hedged. So I would be surprised to see FedEx, even if it's a negative earnings, go below 230. So 230 put right now, it's trading at 50 cents. Or on the upside, I'll be surprised if it's able to jump above 300, right? Because positive Venom means people are selling calls and people are buying puts. People who are buying puts, they're concerned that it's going to drop to 230, so it's well positioned. And people who have FedEx, they're selling 300 calls because they don't think it's going to go beyond 300, right? So it's completely different setup from Nike, where I think majority of the people are actually think that Nike between now and April 19th would be a $120 stock, right? It doesn't mean that's what's going to happen, but that's what other people think. So very important as part of our discussions, right? I always say game theory is very important. If you don't know what a game theory is, right, then I strongly encourage you to look it up, right? Trading psychology. It's not important what Vlad thinks or what, Bob or Fred thinks. It's important to see what majority of the people think, how they're positioning going into these events, right? And FedEx mindset is completely different from when you go to Micron, right? And that is going to be reflected in the price action after the earnings are going to be announced. Questions? Bob, thank you. Charles, hello. CMC broke all-time highs. CMC. Bob knows every single stock. Bob, you should teach these classes. Commercial metal company steel. Yes. One of the themes are, again, it's pretty liquid, 2 million shares. Okay, CMC is breaking out. Materials, right? So materials in general are also breaking out. Right, so the late cyclical, the idea that the value is people are gonna sell their Apple stock, they're gonna sell their Tesla stock, they're not making money on Nvidia, and they're gonna go into the 1995 camp, soft landing. 1995, what led the market? If you go back from 95 to 99, your banks initially, obviously it was internet bubble, technology picked up, but at least initially, right now, that the materials and the banks are leading the rally. Charles, hello. Yes, Charles, they are butterfly on Nikes, right? So these are butterflies on Nike. So you can see 85, 90, 95 put at 76 cents. I need to update interface. It doesn't say like that it's 1 to 2 to 1. So I'll work on that. But for now, by 76 cents, you can kind of determine what that trade is. But yes. Agree, thanks. Butterfly, yes, Charles. I did... on butterflies on Nike. Yes, thank you. Charles, good idea. Yeah, thank you. Most important is to look at the trading room recordings, right? Because just because you get the signal, doesn't mean, you know what to do with this, right? It's good if you're an experienced trader, that's all you need. You don't need to listen to Vlad for an hour. You kind of know, okay, all I need is strikes and I know what to do. But if you're not an experienced trader and, you haven't done butterflies all your life, I encourage you to watch the recordings, right? You can, before you go to sleep and you want to hear my voice, it's a good exercise. I think you will sleep much better, but it's important to at least zoom and fast forward and to understand, why I did this trade. It's very important, right? Actually, a lot of this industry is changing, and a lot of, in terms of regulations, everybody basically says, you're not allowed to basically give signals anymore, right? You can't do, because what does signals do, especially if you're an inexperienced trader? So they basically tell you that you either have to write up, explanation why I'm buying Nike, or you have to watch the video. So there is a reason why regulators actually want you to deliver recordings, right? They want you to deliver the recordings and the thorough explanations to the consumers, right, to the subscribers, to make sure they understand what they're doing, right? So now, if regulators want you to read, then I think you should watch these videos, right? There's a good reason why they want you to do that. And plus I spend a lot of time and energy doing them, and I always get lonely if you guys don't listen. We do have, speaking of webinars, we do have a webinar today at 7 p.m. I'm going to spend more time on trading psychology, game theory, prospect theory, how to position, which sectors lead the market, which sectors lag the market. But this is important discussion, and I hope you can join me today at 7 p.m. Chicago time, Central time. If you're in New York, Florida, or East Coast, 8 p.m. If you're in California, like Max, then it's 5 p.m. Max, are you in California? I think you are. Could be wrong. Okay. It is 251. The other good thing is when I did iron condor, because when you sell volatility, right here I'm buying volatility because I think vol is going to go higher. But if you're selling volatility and doing iron condor, then you have to make sure that you don't have the 2 standard deviation move. Here you have a butterfly. You know what your maximum loss is. You know what your maximum gain is, and then you just tomorrow we'll see if where the stock is going to trade. Any questions? I do like to leave a little bit earlier. What is the best exit strategy on Nike Butterfly? So tomorrow, what I do and what I did last time, I think we'll do, let's see. Same thing that I did on PDD, right? And same thing I did, I think, on Dollar Tree last week. So what I do, I break the trades into 2. Right? What is a butterfly? Butterfly is nothing more than debit spread and the credit spread, right? One position is bullish, one position is bearish, right? So PDD, what I did is I broke it into 160, 152 and a half call spread, right? And I broke it to 145, 152 and a half call spread. So I have a bullish call spread, 145, 152, one by one. And then I have a bearish call spread, 152 and a half, 160. The idea was that as the stock rallied, right, I wanted to close the short call, right? Because when PDD opened, let's just rewind this trade. It's a good case study, right? When the market opened, right, PDD went up, was significantly high. It opened at 140, 150. Actually, pre-market, it was at 152, right? So I was very excited, right? 152. I made $7 on my call spread. I felt good about the strategy, but I had a credit call spread. So I thought there would be a continuation. So I closed the call spread first for 75 cents, and then I realized that after 15 minutes, PDD would just continue to sell off. And usually, if it sells off after 15 minutes, right? After this is 15-minute chart. Let's do 5-minute chart, right? If it sells off after 15 minutes, it's going to sell off the rest of the days, right? That's usually the rule. That's why I wait for 15 minutes. Obviously, there are exceptions. Sometimes it's 20 minutes. But more often than not, if stock moved 2 standard deviation to the upside with such a big force, and it then rolls over and gives up, half of the gains in 15 minutes, that means something, press conference or big hedge fund stepped in and basically did not like the earnings, and then obviously the stock is down. So in this example, I didn't make money, right? I bought for 75. I mean, I covered 5 cents, but still losing trade. But that would be my strategy for Nike tomorrow as well, right? To break into 2 trades. One would be bullish, one would be bearish. Let's say, what do I think? I think Nike is going to, I think the risk is to the downside, right? Because I think China is in trouble. We've seen PDD, and I think retail are going to, anything exposed to China, like Tesla or Apple, they have risk to the downside. So if I have to pick the side, which I don't like to do, but if I do, then I think the risk is to the downside. So same thing. I have a 95-90 put spread, which is bullish. Sorry, bearish that bearish debit spread. Excuse me. Bearish debit spread. So then I would break it into two trades. 95.90, that's a debit put spread, that's bearish. And then 85.90 is credit put spread, which is bullish, right? And my thought process is going to be, and obviously if it happens in the reverse, same analogy, that that October lows will hold. Sorry. That the 90 level will hold, and idea to first close the close the debit spread if it reaches $5. Sorry. And then close the credit put spread. So 90.95 maximum gain is $5. 90.85 maximum loss is $5. So I want to manage them and try to, if it reaches 85, 90 level, try to get as much gain as possible. All right, sorry about extra cough. See you tonight or tomorrow AM. Yes, so tonight, if you guys free, would greatly appreciate if you can visit us 7 p.m. Chicago time Central, 8 p.m. Eastern. And we do have Yellow Tunnel on Twitter. A lot of webinars, a lot of blogs. You know, every time I appear on Tradier, it's get posted. So please follow us on Yellow Tunnel for timely updates, timely, signals. And I think hopefully you will enjoy the content. So please find us and follow us on Yellow Tunnel on Twitter X platform. Tradier Hub, thank you very much for your time. Hopefully I'll see you next Thursday, same time. And hopefully you can subscribe on our Twitter channel. Thank you very much and have a great day.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.